considering. Now, notice how I say you could arguably, not because this is actually pretty interesting. Just say we were to close here. You could argue, well, we're making an uptrend or we're making a downtrend, but I would say the closing prices are the more important prices than the openings. So I would go based off of the closings prices. And then we were looking at the financial sector. That looked pretty. Yeah, look at that, where it's still sitting right there. Now, again, this is lower than yesterday's close. So even though it's only 12 cents, it's kind of, given where the market is right now, it's kind of an important thing. Where, we're thinking maybe we get some kind of a sharp rebound, or maybe we get some type of a breakdown. I mean, if XLF starts to break down through here at the same time as XLK starts to break down here, we're going to get some more of those big gaps lower. And I noticed, where did I see something? I noticed on a mainstream media, quote unquote, outlet that they're finally talking about market going lower. So that tells me that now it's getting out into the public that things are really bad, right? Remember, we started talking about it back here, that things were starting to look pretty weak. But now it's getting out to the people that would ultimately be the last people to sell. So I think that's another sign of bearish sentiment, but I don't think we're there yet. But when those people start throwing in the towel, when those people go back to their, when the day traders start going back to their regular jobs, I wish somehow we can monitor. I don't know. You guys might know more about this than me because I've never been on Red, but is there a way that you could monitor? And I know, like Seaford was talking about maybe making some kind of an indicator. I mean, this is something just to think about. I'm not saying do it, but it would be pretty cool. Just something to think about. Like, if there was a way we could measure like the chatter or the amount of talk or something in the Reddit stock rooms, or trading chats or discords or whatever the hell you call them. If we could maybe get a chart of it, and when you see it like really start to fall off, when that community really is not trading much anymore, then that could be an indicator for us. So I don't know if it's possible to obtain that kind of stuff. I'm sure people at Reddit are probably aware that it's something that they could monetize and sell. I mean, that's what I would be thinking. I mean, if you're the CEO of one of these companies, like TD Ameritrade, I mean, think of TD Ameritrade has, I don't know how many, I know a bunch of you guys use them, how many millions of clients. And if you're the CEO, you have access, or the management, senior management, you have access to all of the trading in the retail world. So you can build all kinds of indicators and in things like, how many accounts did we open? Because when things are really heating up, a year and a half ago, we saw like IBKR, they were just opening way more accounts, right? Once that amount of accounts opening per month starts to drop off, that probably would have dropped off before the market actually starts to drop off, but that would be a really good indicator to look at. So it's almost like these guys have access to as perfect of an indicator as you can get. I mean, if you find people that are consistently wrong, you could always take the other side of the trade. You could sell how many website hits did you get every day? That could be something. How many incoming calls did the staff field? All right, so let's go back to where we are here. All right, so let's go over to our healthcare sector. Wow. All right. Yeah, this is it. This looks pretty ugly here, guys. This is where the weakness is coming. And this kind of fits with what I was just saying. Like these are the stocks that people would sell last, quote unquote, the safe stocks. Now, this is the second biggest part of the market. So that's why S&P is trending lower, because this weakness here. And we can see we're below an important level. This 121 was like perfect support back here. And we are trading down into not what is technically a gap, but what could have some kind of the same gap principles, in the sense that when you make a fast move through a level, there's just not a lot of time for a vested interest in here. Generally, we talk about support forming because it's selling and they want to buy their stock back. So if it goes higher and then comes back lower, they place their buy orders at the same level they sold. So when you gap through something, do I look okay here? It wasn't an indicator, but it's something we could make an indicator out of potentially. It's maybe a little bit of a lagging thing, but this is just, uh, this is a school, and we're supposed to having discussions to make our minds better. So this is just like something to consider. Investor relations. Let's go to that. And let's go. Yeah, see this monthly brokerage metrics. Now they get this stuff daily, right? So they know day to day what's going on. They only release it monthly. All right, so this here, monthly broker statistics. All right, so let's see. So 2022, that's where we are now. So net new accounts, let's look at that. So net new accounts, I guess that's 42,000. Wow, 42,000 new accounts a day. That's a lot. I mean, all right. So anyway, 42,000. Now what we have here, 2021. Look at back here, 116,075. And this is where the Reddit crowd start to blow up. So if you had access to this data and you started watching this net new accounts, and it's like we're kind of, churning along here, 36,000, 37, pretty steady, 26, 36. Then when we get over here into 2021, the peak of the Reddit uh, movement, I guess, we go up to 116,000. And then we have this steep drop to 75, and then another big drop to 60, and then we're right back in the 30s. So by looking at this back then, you would have said, oh, this is people spending their stimulus checks, right? Reddit people spending stimulus checks. And this just fell off a cliff. So this would be something that you would look at in terms of a sentiment indicator. So the guys, though, that work at this firm, and you can be, bet your, that they're looking at this stuff. And if there's ways they can legally sell it to certain places, they're probably doing it. But this is like really, this is like almost as good of an indicator as you could possibly get. So, what are some of the other ones? Toronto Dominion Bank. So this isn't TD Ameritrade. Is this some Toronto Dominion Bank? Is that the TD Ameritrade? Hmm. All right, so maybe it is under TD. That's why it's TD Ameritrade. What am I spacing on here? One of you guys got to have a symbol for me here. TD Ameritrade is owned by Schwab. All right. All right, so let's go look and see if Charles Schwab. Look at that. All right, let's see if Charles Schwab releases the same kind of information. About Schwab Investor Relations. All right. Investor Relations. Latest financial report. View table. Let's just look at the table here. Okay, open. The Charles Schwab Company. Okay. Yeah, I mean, you could get something out of this here too. Like if you really study this and get in depth, net new total client accounts, core net new assets. Actually, active accounts, client activity, new brokerage accounts in thousands. So I don't think they go back far enough. So that's May of 2021. Yeah, we'd want to look earlier in the year. Yeah, I guess they don't have it. All right, let's see the other ones here. View table only. All right. Yeah, darn, it doesn't go back far enough. Well, you get the idea, right? Schwab acquired TD Ameritrade. Yeah. Well, anyway, it's a pretty cool thing that if you probably just really looked at this for a while, you might like come up with stuff. I think the other one is a little bit more. Yeah, I think the IBK one is it might be give you a little bit more insight. What are other publicly traded? Publicly traded. I wonder if Robinhood has something like that. Or Coinbase. Yeah, we'll have to look at Coinbase too. So let's see. Quarterly results. Press release. Oh, these guys have their earnings transcripts. That's pretty cool. All right. So I guess they maybe don't really release those, although it would be in the annual report if they do. All right, let's see if Coinbase, because we know Coin is in trouble. So the idea is this whole thing of psychology is what we're talking about, right? If you have all these people opening new accounts, that shows euphoria. Wow. The 10-year yield is up to 345. Man, this is getting to the point where this is getting like disastrous. I mean, things are going to get bad. unfortunately. All right, let's just see here. Oh, look at all the education they have. Yeah, I guess that's probably not something that they release either. But there's information, that data is worth money, right? So, stock information, financials, shareholder letter. It's not good when you see the shareholder letter. A lot of times those are like the mea culpa type thing. Yeah, this doesn't phase us. Yeah, famous last words, right? Um, so this is from May. So this is from a month ago. And right? May is 5. Yeah. So this is from just over a month ago. And think of how much stuff has changed since then. I mean, since then, crypto have crashed in the months since this was put out to now. But a lot of times, man, when you see these like shareholder letters, that's a warning sign. So let's see where Coinbase was when they came out with this on May 10th. The birds barking at the guys that are out paving my road. I mean, not that's my road. I don't own it. All right. So May 10th. Yeah. So that came out here. So I guess people knew. Yeah. There hasn't been any recovery. But let's go over to Bitcoin too. That's doing. All right, Clifford. All right. So May 10th was right here. So right when we got into this range. Well, anyway, just an exchange of ideas. I don't know if you guys can come up with things along these lines. But the idea is when we get to a point where we get really euphoric, right? Like all the Reddit traders did. Um, Not all of them, but a lot of them. All right, so like if we go back here, right, when it really took off, like this is when people were opening those accounts. This is late January of 21 and early February. So this is people opening the accounts. And when we see an extreme, when we're traders, we always have to pay attention to things that are extremes. Extremes are, overbought, oversold. But with the sentiment, if you see an extremely new amount of net new accounts being open, it's like, wow, why is there an extreme? And when you get people that don't typically buy stocks, like most of the Reddit crowd, before all this started happening, start buying, there's no one left in the food chain to buy after them. They're the last people in line. There's no one who's going to push the price any higher. So the really smart people are the people who bought GameStop, I guess, back here, right? Just philosophically, as it gets higher, the people who are buying it at higher prices aren't as smart as the people that bought at lower prices in general, I mean, just in terms of stock market stuff. So I would imagine a bunch of the people that bought down here were the ones who were selling up here. But when you have this rush to everyone going the same way, the market effectively runs out of buyers, and then there's no place it can go but down. So when you're like in the internet bubble, or I'm sure probably going into last year, when I was out at dinner when I used to work, if the waiter is like, oh, you guys are in the stock market, oh, I just bought this, I just bought that, that type of stuff was probably going on back here. So that would be a pretty cool sentiment indicator. I think somewhere in there are probably some ideas. So if you guys can come up with any other things, hi Chica Blue, hey Jen. Well, I didn't really call it. Market kind of saw it. How will the SPY close on Wednesday, 6:15? I'm going to go with very red. All right. I'm going to go with very red. Another sentiment indicator that people look at is like headlines. And a lot of this stuff you can't quantify, like what we were just talking about, but some of it's like anecdotal. Like there are famous examples of right at the top of like a bull market, like Barron's had. Wow, look at that! Wow, I don't know, born to be. You think you'd drive one of these things around, man? uh, Born to be used to drive the Abrams. But anyway, when you start to see like there's just famous examples where like Barron's puts the bull on the cover, and that's like the issue that's like the top of the market, or they have the bear on it, and that's the bottom of the market. So those are things we can look at too here for sentiment type things. uh yeah. And like I said, now it's kind of getting out into like the more of the mainstream, in the sense of not just people that are trading and investing. Like now, like regular people are starting to hear that the stock market's falling apart, and they are going to typically be the last people to sell. And we might even be seeing some of that here, which is why healthcare is so weak, because healthcare stocks are supposed to be considered safe, but we can see that this is what's leading us lower. And the other sector where that might be possible is, let's take a look at your utilities. Yeah, I mean, look at this. Like this is like, I don't want to make any you know inappropriate jokes, but this is like grandma and grandpa or Aunt Mary selling. Like this is utilities, man. These things are supposed to be safe, and they're in an absolute free fall. But what's very troubling is this absolute explosion in these interest rates, these 2-year rates we've been talking about. And look at that, man. All right, let's go look at it in perspective here, though. So we got to get all, and we're going to make that logarithmic, and we're going to do that. Wow, look at that. I mean, this is like bad stuff, guys. And people might argue, oh, well, it's still below, it's still below its historical. Uh, Why doesn't this go back further now? Oh, wait, I know why. 10-year yield. Huh, it's kind of weird. It used to go back to 1963. Maybe I got the wrong symbol in here. Let's see. T and X indices. All right, guys, I know I'm not crazy, right? We were looking at the chart that went all the way back. Well, anyway, it still shows the same type of a thing. Like historically, you could argue that rates are still lower than they have been, but it's not really the rate as much as it's the rate of change. And we've gone up, these yields have gone up 10%, more than 10% in just like a short period of time here. So this is the bond market collapsing, because bonds move in the opposite direction of stocks. So you can almost imagine this as like an inverted stock chart. So where this is breaking out, the bond market is breaking down. I want to get a better look at that. Or wait, actually, what am I doing here? Yeah. All right, so this is almost hard to believe. Let me just make sure I'm doing this right. All right, so that was 30 on June 8th. Dude, that's like a week. 2-year yields are up 10% in a week. I'm sorry, these are 10-year yields. Oh, now I know I was doing wrong. I had the wrong symbol. I want the 2-year yield. Well, anyway, it's going to look the same. So that's a really pretty frightening thing here. All right, and now let's look at what's going on in the commodities part of the market. I mean, I got to tell you, I think in my career, I don't think I've ever seen things set up like this. I think we could really be going into some really bad times here. I mean, I know hindsight's 2020, and it was a long time ago, but I remember like stuff like really starting to set up before the market blew up in 2008 and 2009, and I don't know, man. It's almost like things are setting up worse because we have we have stocks in free fall and bonds in free fall, and they usually don't trade the same way. They usually historically trade in opposite directions. So the fact that both of them are going down is a little concerning, or a lot concerning. So anyway, I guess is the 10-year yield. This is so weird, man. This chart went back to 1963. I know you guys know I'm right. um, so that's what we think about when we talk about with sentiment. Sentiment is like the mass market psychology. That's why you've probably heard the expression. Sorry, I don't want that. Well, you know, buy, like they say, buy when there's blood in the streets. Like Warren Buffett always gets credited with saying that. That's what people are referring to. When there's blood in the streets, when everyone's selling, there's just no one left to sell after. And in that situation, the only place the market can go is down. Nothing wrong with a little jokey joke. Ford wants sales of Mustangs. Let's see. Yeah, Ford is getting crushed. And you guys have electric cars? Neat dog. What do you got here? Ford halts sales on Mustang. And a setback for EV business. Oh, it's a safety defect then. Yeah. Well, it doesn't really seem to be affecting the stock much. At least not yet, if that's just coming out. Thank you. Well, no patience trades. If we think the market's going to go down, there are ETFs that we can use to trade.
Hey, really quick, guys, just before we continue here with the lesson, because you guys are sending a couple messages and questions about how you can join the school. Just want to let you know, if you are on YouTube, it is on the chat. We did post the link there, and it's on basically on the chat. You could see it there on the description. And if you're on Twitter, you could see it right there, pulled up right inside the Twitter space. This is to join the trading school with Mark Putrino, former hedge fund manager. And if you are on Zoom, also keep in mind, it's going to be on the chat as well. It's $7 for 7 days. That's your trial period. After the 7 days, it's $14.97 for the year. You get Benzinga Pro. It's for the whole year with Mark. You have classes Monday to Friday. I'll put the contact there if you guys have questions, but let's go ahead and carry on here with the session with Mark Putrino from the trading school.
They're going to go up. Like, for example, let's go look at the Nasdaq 100 here. Now, it's not a trade recommendation. I'm just putting some ideas out there. Think if we get down to here and we break here, if we break support, we keep getting lower. And I know patience trades that some of the people that are probably in the class right now did really well when this started to break down here, when we broke this clear support. And the way we do this is we have what we call inverse ETFs. So there's one that a lot of the students like to use that actually is designed to go up 3 times as fast in the opposite direction. So if this thing on this particular day was down 2.7%, down 3.5%, down 4.6%, if you want to buy something like this, look how high this is, look how much this has moved up. So 8.1%, 10.7%, and 13.6%. So we don't want markets to go down, but they do. That's just how markets work. And there are a lot of ways now. There are a lot of vehicles that you can use to make money. I think so. Matty B, I think you did all right, right? I forget because I think there was a bunch of you guys on this one. Um, but yeah, so in a lot of ways too, in a lot of ways it's easier to make money on the downside because things go down faster than they go up. So if you don't want to like go crazy and have something that's triply leveraged, because this could go against you too. If the market starts going up, this is going to go down 3 times as fast. So leverage is great when it goes your way, but something that's a little bit more conservative. Well, if you're like completely, if you're aggressive and you have a high risk tolerance, people might even buy options on this. Something that's a little bit more conservative is this. This one is designed just to move in the opposite direction of the S&P 500. So it looks big, but in terms of a percentage, um, it's not as much as the one we just looked at. But while the market's been falling apart, this thing's been skyrocketing. I mean, maybe not skyrocketing, but it's up big. Yeah, the bond market. There's a bunch of bond funds. They don't really give you clear signals because they're an aggregate of a bunch of bonds. So this is well, I shouldn't say that. You do get clear signals because people trade these. I mean, this trades 3 million shares a day. But this is different than it's important to understand this is an ETF and it's an aggregate of a bunch of different bonds. But all that being said, it shows the devastation that the bond market has had. This could be the worst. I know it was the worst first quarter in 40 years. And my guess is that this here could have been the worst month in the history of the bond market in terms of how much the prices went down. So March to there. So we went from 113 to 106, which doesn't sound like a lot, but it's you got to understand these are bonds, so they don't really move around too fast. But we're going to get back to what I've been talking about with this, or this could circle around or back or whatever the new expression is to our commodities thing and oil. Actually, oil was on the move before, so let me put that up there. So this is how this works, and you're not going to hear people talking about this. But I actually remember when it happened back before they invented electricity, Pat, when we used to trade on our telegraph wires, place our orders on a slate with a piece of chalk. But anyway, here's what's going on right now, right? It's not the hedge funds, the institutional money managers, the mutual funds. They're not the top of the food chain on Wall Street. The very top is the pension plans, the endowments, the people that need money to get managed for them. So they're ultimately the people that decide where does this money go. Like if you're in a union and you have a pension, well, your pension money is being managed by money managers, and the head of your pension decides where that goes. So what's going to happen, I think, which could really, really get inflation going. And what's interesting too is that inflation is hyperinflation is defined as over 50% in a year. Look at what CRB has done in the last year. It's up over 50%. So you could even say there's a hyperinflation going on in some parts of our market, and you would not be wrong. But going back to this, right? These pension plan managers are going to be looking at their statements from all their different managers, and they're going to say, wow, our stock portfolios are really getting crushed. Uh-oh. Well, sometimes when stocks do bad, bonds do good. Oh, our bond portfolio is getting crushed as well. Uh-oh. What's doing well? Oh, our commodities portfolios are doing well. Let's go move money out of the market into commodities. And that's probably started. And as we know, when we have really steep, powerful moves off of a bottom, that's bullish. But when we have a really steep, powerful move after an uptrend, a lot of times that is bearish. So let's just get a good number here, right? So 211 to 321. I was trying to figure out why my calculator doesn't work, and then I realized it's solar, and I got the light off in here. But anyway, you can do the math, right? That's yeah, so that's over 50% higher. So you could say the CRB commodity index is arguably in a hyperinflation because it's up over 50%. Mark, is there a correlation between what's happening now and back in 1930? Oh yeah, dude, absolutely. History always repeats it. I mean, history repeats itself. That's why I think it's a good idea for those of you who are interested to read that book, Reminiscence of a Stock Operator, um, because it talks about what was going on in the 20s. And it's the same, history repeats itself, but well, like Mark Twain said, history rhymes, but it doesn't repeat itself. Or wait, history doesn't repeat itself, it rhymes. So it's not exact, but you get a lot of the same things. There's a lot of characteristics that happen in bubbles. One is really low interest rates, two is retail buying. You know, just like the whole Reddit thing where you have people that um, don't typically buy stocks or buying them and they're the last in the line. So there's no one else behind them to push the price any higher. That's exactly what we saw back here. Well, now that we saw it, well, actually, I might have seen it, Pat, right? Um, what we saw back here when we have the legend of um, Joe Kennedy getting his shoe shines, and the shoe shine boy told him, "Oh, you should buy these stocks." And Kennedy thought, "Wow, if shoe shine boys are shining or buying stocks, there's no one else in the food chain behind them to push the price any higher. The market effectively runs out of buyers." So market sell-offs end when the market runs out of sellers, and market rallies end when the market runs out of buyers. So, but if you go back into history, it's very similar, like where we had the rise of day trading. Back here, we had the rise of what we would call bucket shops, where there were these little places in cities all across the country where they would have the stock ticker tape and people would go and trade. So those were their errors, day traders. In the internet bubble, day trading became huge. I mean, there were so many parallels to what was going on. I mean, I guess this is the third one of these I'm living through, but these big moves lower. But yeah, you know, there's so many similarities, and this goes back to psychology. Like, if people were perfectly level-headed and cool, who knows? Maybe the market would just go in a perfectly straight line. But when we get, you know, overdone, it's because of a panic. When we get overbought, it's because of too much euphoria. So I would say there's absolutely correlations. So again, this is the Dow going all the way back to the beginning, 1897. And this is a good thing to look at too, because we have to keep things in a historical perspective, because human nature hasn't changed. So if the Romans or the Phoenicians or the Greeks, if they traded stuff and they had charts of it and they charted it, the prices, I would imagine it would look very similar to how things look now. But while I'm here, let me just show you guys this again, which I would like to point out to dispel the myth of the buy and hold strategy. Buy and hold works great in 10-year long bull markets like we just came out of, where the only real down thing was COVID, which was basically a blip on the radar screen in terms of the stock market. Right now, would buy and hold have worked back here? You know, if you bought the Dow Jones in 1965 at 1,000, you weren't making money until 1982. So back here, no one was saying buy and hold is the best strategy. People were saying, oh, you need active managers, people that are going to pick the best stocks. And now you'll start to see, I mean, you've already started seeing the commercials now with like Fisher Investments and all these other places are like, oh, you know, we have active managers that are on top of your portfolios. These same people a year ago were saying, oh, you know, you should just buy the ETFs, passive management. So there are definitely correlations. Hello, Melissa. Melissa's right by New Haven. She's in Hamden, I believe. Oh yeah, totally do. Boris, the stocks are in a free fall because people are afraid and have a habit to scare others. I would concur with that. But yeah, I think there's really, yeah, of course. I mean, with interest rates up so much and oil prices up so much, you know, a lot of uh, a lot of these trucking companies, they start to get to, if diesel fuel starts to get up to around $8, $9, $10, like they're not going to be profitable. They're not going to run. We could be on the verge of the trucking industry just completely shutting down. Because if you're a trucker and you're going to lose money on trucking, your freight across the country, you're not going to do it. So diesel prices are at all-time highs. If oil breaks out here, I think oil is on the verge of breakout, moving higher. Yeah, I think we're in pretty big trouble, frankly. I think it's going to get pretty bad. Don't get me wrong. I don't think it's like the collapse of civilization or anything like that. Um, that's probably going to come from an asteroid. Hopefully, no time soon. Or if it does come out, hopefully it'll hit my house first, so I won't notice it and won't have time to be afraid. Um, but yeah, like back here, um, in this bottom right here. All right, so there was a lot going on in here. This was the housing bubble. This was Obama just got elected, and people were afraid we were going to get socialized health care. So there was a lot going on in here. And I literally remember in March and April, right at the very bottom, people calling me, like people that aren't in the stock market, like cousins, uncles, people like that. Like, is this really like the collapse of, is the economy going to go into collapse? And I said, I think you should invest your money now. Now's the time to buy. And they're like, well, what if the economy collapses? And I said, well, then your money won't be worth anything anyway. So you really got nothing to lose. And they're like, oh, good idea. And that was at the very bottom. So, people were scared, man. Like where I live, it's a suburb of New York City. So there's a lot of Wall Street people. And, I would ride my bike around and here, you just start to see for sale signs on all the houses, because Wall Street people have a tendency to buy their house based on what their last bonus was, assuming that they're going to get those bonuses again and again. And a lot of them, it just doesn't work out that way, because when you're up here, it's easy to get a fat bonus. When you're down here, it's not. All right. So that was a little bit of but yeah, I think we're in trouble. I don't know. Any guys in the trucking industry, do you have any insights on where the break-even point is for profitability? I guess we could probably look at like JB Hunt and Old Dominion and figure, maybe get some insight from them. All right. Well, looks like this guy's gotten down to support again. But look at that selling. So yeah, this is actually a big trucking company, so they probably have lower or better economies of scale. But I know the little guy is really hurting, and I know that it's not just diesel. Those big trucks, they got to replace their tires a lot, and their tires are made with oil in them, right? For those of you who don't know, my stepfather, he's like actually being like forced into retirement after 52 years. He's 80 years old, and he's probably in better shape than half the people I know that are 50. But it's gotten to the point where it's just getting to where it's not profitable for him to run the business anymore. Now there are probably bigger garbage companies that can bear the cost better. But at what point does your garbage bill get so high that it's like, oh, I'm just going to go to the dump myself on the weekends? I'm not going to pay a guy to come get my garbage anymore. Like where I live here, we don't have in this part of town, you don't get town service for your garbage. You got to pay a garbage man to come get it. So yeah, man, I think that I think things are really unfolding. I mean, the market is the stock market is a leading indicator, right? And we're going to have this thing called the wealth effect, where people that that don't follow. I don't want to say not sophisticated, because I don't want to imply that they're not smart, but people that don't follow the market, right? We're now at June 14th. In 2 weeks, it's going to be the end of the quarter. So a lot of people are going to be opening up their 401k statements, which they get quarterly, and they're going to say, what the beep? And that's the wealth effect. Now, all of a sudden, if say theoretically someone thinks, oh, I'm okay. I got $1 million in my retirement plan. I'm going to go out and have a nice dinner tonight. I'm going to go to a top-notch restaurant. Then that same person opens up their statement and say, wait a second, I thought I had $1 million. Why does my statement only say 500,000? It's like, oh man, I've lost $500,000. I'm not going out anywhere. I'm not spending any money. So that's a big part of it. So, and like I said before, when we got going here, I think we're starting right now to get, it's starting to get out into the parts of the population where people, that don't follow the markets are going to start to notice this. And I think a big part of that's going to happen after people get their June statements, because obviously people have access to this stuff all the time, but they tend to just look at the end of the quarterly statements. Okay, cool. Yeah. Mark Alexander fell. Yeah, no shrimp cocktail, man. Mark, I am a truck driver. We add fuel surcharges to loads. Yeah, but at some point that's going to have an effect, right, Steve, where people are going to start saying, well, maybe I buy a little less. Oh boy, maybe the world is coming to an end on Friday. All right, well, if the world comes to an end, we're not going to have class on Friday. So right, so if there's no more world, there's no more class, unfortunately. Just one of those things, man. Yeah, the customers are exactly. Steve says, or patient says, the trucks charge that, they will charge their customers and charge their customers and charge their customers. And well, the oil is not up just because of Russia. I mean, it was up way more before that. As a matter of fact, we wouldn't have had the Russia-Ukraine thing if it wasn't for the fact that oil was up, right? Because Russia is an economy that survives on oil, and I think they need to have oil to be about. This gets kind of messed up here because we had the place where oil actually went negative, and this was because of COVID. And this can't happen in a stock, but it could happen in a commodity because there's actually had to be delivery. So, all right. So now this is where Ukraine started. All right. February of 22. This oil rally started really to get into gear right here. See, you went flat. This is where we really started to move. So oil was at $36 a barrel. So this is American energy policy. Biden came in and he changed everything. This is the election right here. And that's when we started to take off. The guy said he wanted to destroy the energy industry. So then I don't think anyone should be surprised. But no, don't buy this Ukraine thing. If oil wasn't up here, there would be no Ukraine. If oil was still down here, there would be no Russia-Ukraine conflict, in my opinion. And I saw in the paper today that we're actually still buying oil from Russia. Now they're talking about, oh, we're going to phase it out in December. So just more hypocrisy. We will find out when Amazon stops showing 2-day shipping option. Wow, that's pretty darn insightful, actually, there, Let's Z. Huh. I'm noticing more people sharing entrees at my restaurant. Oh, that's right. You're in the restaurant business. Yeah. That's pretty, yeah. I like that. Like when that Amazon Prime guy takes 3 days to get to your house instead of an hour. um, that could be a sign. Uh, so, it's not any coincidence that if you go back in history, the last time Putin went to go invade another country, Georgia or Ukraine, it was also when oil was up around $100 a barrel. So that's my take on it. I mean, maybe I'm wrong, but that's just what I think. I mean, I think it's all in the charts. I don't listen to politicians. I don't listen to analysts. I just listen to what the market says. So this is coming out of COVID, and here all these big places that had oil like stuck up in their trucks and their oil silos or tanks or whatever you call them, they actually had to pay people to take it away from them. So oil went to a negative value. So you won't see this on a stock, but it is possible on a commodity. Very, very, very rare. I've only seen things that happen a few times. Next CPI report will not be better. Trucking inflation hasn't taken an effect yet. Can you explain that a little more? Is that because trucking inflation takes a while to get to the end user, so to speak? Well, I mean, Boris, I think oil. I mean, look at the chart. This is where oil really starts to take off. We got this big move higher here. Then we go sideways, and then I mean, we're still. If it wasn't for COVID, we would still be in a downtrend. So, yeah, I mean, charts don't lie, so, and charts are never wrong. So anyway, going to a shorter term perspective here, we could be on the verge of a breakout. All right, I know what I'm doing wrong here. Right, and this is our not a perfect ascending triangle pattern, but I could argue this is an ascending triangle, and a lot of we had this big spike here, and this is when the Ukraine war started right here, right? We had this big spike, this like panic buying, and we got up around here, and this is where there was resistance. So then we went lower, had this little thing here, but now we're starting to move higher, and we got these higher lows, higher lows, higher lows, and now we're up to here, and we're hitting this resistance again, right around the same level. Right, this was pretty volatile because this was like panicked buying, but you can see that the level's really kind of tightening up in here. I would say it's like 122. So I think this could be on the verge of a breakout and would continue to move higher. And look at it today; it actually got all the way up to 123.68. So it seems like it's starting to take out that resistance. So if this breaks out, we could get a decent move. But the whole idea with the ascending triangle is that as time is going by here, the buyers are getting more aggressive, but the sellers are hanging at their level. So you have increasingly aggressive buyers and complacent sellers, that sets the stage for the market to move higher. Yeah, it takes months to have that. Yeah. All right, Steve. Appreciate that. Mark, from a technical perspective, stock is breaking up. All right, I'm going to take a second to go through this here. From a technical perspective, a stock is breaking, if a stock is breaking up the downtrends on a daily chart, but the Nasdaq or S&P are going down, would that mean the stock broke the downtrend? Well, it probably has more to do with what sector it's in, because the market could be going down. The market consists of 11 different sectors, and we look at all those. And one of the things we do here as part of the school, and we'll do that before we wrap up today, is we go through all the sectors. But there's 11 of them, and the biggest is technology, which is about 28%, and the smallest is, I think, materials, which is like 4%. So just because of the way the math is done, the S&P could be going down and stocks in the materials sector could still be going up, or vice versa. So it's probably more of a sector thing, I would think. JP on is a bottom feeder, and good drivers don't work there. What are some of the other truckers? Actually, let's look at the trucking ETF here. All right, so this is I'm sorry, this isn't trucking. This is transport. So this has airliners in it and so forth. Wow, look at that. Man. Ugly. Look how clear this resistance is up here. See, it's one of the fundamental things we talk about. Some price levels are more important than others. And we can see here 280 for whatever reason, just so happens to be important for this one. When it got up to 280, that's where the sellers came out of the woodwork and put a top on it. So this is what we talk about when we say a market has a memory. When things get to former tops, they tend to run into resistance. When things get to former bottoms, they tend to find support. But bottoms are harder to call because bottoms tend to be more volatile, because bottoms come from panic selling, whereas markets go up on hope. So in general, markets tend to go up slower than they go down. So how are airlines? Aren't some of you guys short some of these cruise ships? I mean, you're welcome. I think a couple of you guys have shorts in some of these cruise lines, if I'm not mistaken. And I mean, it doesn't look to me like this is coming back anytime soon. You know, I mean, it's oversold, but it just still has negative action. And look at that, man. We're approaching our COVID lows of around 815. So maybe there's some support down around there. Steve was short CCL. Okay, cool. Hopefully, well, I'm sure he's on top of it. All right, so let's go through here. Oh, wait a second. I can't believe I forgot to mention this. You guys see what's going on in natural gas? Look at that. All right, so let's talk about this. And I know Chad, I don't think Chad's here, but I know Chad did really well up here with our inverse ETF. All right, so let's talk about this now. When we look at commodities, and people might think like, oh, well, you know, I'm not a commodities trader. What am I going to do with that? Well, for the most part, we could get exposure to commodities through ETFs. And there are ETFs that are designed to move in the opposite direction or in the same direction as natural gas. So look at this. For whatever reason, is there some kind of news in the natural gas markets? LNG plant shutdown. Natural gas falls as a sweeping heat wave through the Midwest. A fire at LNG. So then why is it down? National Weather Service is warning of dangerous heat. So why is it down? Anyone got any insight? Anyway, had you known this move was going to happen, and you could have gone into this ETF here as KOLD, which trades twice inversely to natural gas. So this here, it doesn't look like much. This is up 30% today. It goes off the scale because of how it's inverse, but yeah. So you could have been up 30% today if had you known natural gas was going to go down. Well, let's take a look at it and see where we can potentially find some levels here. All right. Now, I would say if we start to rally, yeah, good observation there, Born to Be. It's an action thing, right? Like we think it should be. Going back to the gold and the silver thing, I actually talked to my friend, and I'm not really 100% sure to get my mind around this, but I have a friend who he writes a newsletter, and does research for silver and silver companies. And I was like, well, with all this inflation, why isn't gold and silver going higher? And he was saying there's two things. One is that for some reason there's not enough demand, not as much demand from central banks as there used to be. And the second was, he said, because both the dollar and the yen have been weak at the same time, that's affecting the price. So I'm going to have to think more about how that actually works. But that's what he was saying. All right. So anyway, let's look at this for some potential trade ideas here. All right. Now let's think about this too, right? Let's get our ETFs here lined up. So we got UNG if we want to just trade the regular natural gas, right? This is going to move about the same in terms of percentages. We got BOIL, BOIL, which is going to move twice as much as natural gas does. And then we have cold, which is going to move twice as much in the opposite direction as natural gas. So in that framework, let's go back here and look at rallies back up to 810, but it doesn't get through. If support becomes resistance, it's a good chance we start to trend lower. And that's when you think about buying cold. If we get down to here, there's former support. So that would be a place to cover out of the short. We get back up here, we don't get through. We get back down here. We get back here, it looks like we're going to hold, then that's time to buy. So these levels are easy. This is 7 and this is 810. So we just got to see which way it breaks, and we got to see why is this move down so big. And European natural gas prices rise. Who knows, man? Maybe some big hedge fund somewhere is blowing up, going out. You know, we're gonna see that if it hasn't started happening already. So now, if we break 7, next stop would be down here around 630. This line here. So the levels here are pretty clear. So there should be some money to be made here over the next few days or so. I mean, we got clear support, which might become resistance. We got clear support here. We got clear support here. So markets, they don't go in straight lines. They go in stages. And as they're going down, they break support and then they move down to the next support. Then they kind of hang out for a few days. Then they break that support and go down to the next one. It's like a staircase. Should we get into trading currencies and buy foreign money? I mean, if you want to, you got to do what fits your personality. If you're like into studying currencies and if that's kind of like your thing, then yeah, I think you should get into it. But I don't think you need to. I think you got to do a big part of being successful, Steve, is that you have to do what fits you. Someone else's someone else might have a completely different personality than you. So this trading styles that would work are going to be different. Some people are like, high energy and they want to be day traders. I would imagine if you're a truck driver, it would be hard to day trade. I wouldn't want you, day trading while you're driving your truck. Could lead to some that could lead to some problems. But yeah, I mean, if that area of the market interests you, then by all means. It's not as it's probably not as complicated as it sounds, and you see a lot of the traditional chart patterns in currencies because most currency traders are really technicians. So that's why you get these perfect levels here. Price is down because supply is up. Wait a second. Could have been. Price is down because supply is up. This is because of an explosion. Well, how would that make the supply go up? Wouldn't that make the supply go down? Oh, maybe because it's an export terminal. Now they're not exporting gas and it's staying here. Maybe. Yeah, I don't know. Can you elaborate on that a little bit? We did. This is subject to some freaky behavior. You guys remember back here? This was one of our first like real profits on natural gas. We bought it, or well, I recommended buying it at any rate. Back here, right when we broke out, and our target. So I recommended buying it like right around here, like 425 after we broke out, and our target was up here, and that's because it was a former support level. So we have people who bought here, and then when it goes lower, they're sitting on a losing position, and they tell themselves they want to get out. They don't want to lose money, so they put their sell orders where they bought. So this trade worked out really well because for some reason, and to this day we don't know, we had this massive move higher here, and it got to our target like in a matter of days, like literally in a day. But there was no news that drove this. Maybe it's just a kind of a refill the gap kind of a thing. Fast move down, fast move up. So who knows, man? Every now and then these things make moves that I guess don't make any sense. But that's pretty it's a pretty big move there, man. I don't know if I'd get into cold here, Dan. I would probably wait to see if we reverse and we don't get back above 810, or if we start to break down here. If we get down here and it looks like we're going to hold at 7, then we buy the boil, right? Which is will go up twice as much as this would go up, assuming it does. Pipeline and Hazardous Materials Safety Administration said Freeport LNG fire probes sees indication of a pipe leak. No, that's not good. The price in Europe went up on that news. So maybe that's it, right? Because it said it's an export terminal. So in Europe, the price of natural gas went up. So maybe because the export was supposed to go to Europe, and now the natural gas is going to stay here, and they're going to sell it on the U.S. market. I mean, if I had to take a guess, that's what I would say. Sounds like sabotage. Craig posts, natural gas prices slumped in U.S. and soared in Europe on a lengthier shutdown. Yeah, that's got to be why. It's a major supplier to Europe. So now the oil is not going to, the gas isn't going to Europe. It's coming back into the domestic market. So that's probably what's driving this. The price of natural gas in the United States is different than the price in Europe. It's not a global market like oil is in a lot of ways. So again, we get back down to 7. I'm looking for a bounce. If we get back up to 810 and we don't get through it, I think we're gonna go lower there. Do I think SPY will keep going up? Oh, let's see here. I don't think so, Chica Blue. I just can't conceive of anything that they could possibly say out of this meeting that's going to make people bullish. I just can't see it. And I don't even know why this Fed has any credibility anymore. It's like in general, you mess up and you get fired, but I guess in the you work for the government, it doesn't really whatever matter that much. I think if they come out and do 50 basis points, it's like you guys aren't doing enough. That's going to put the market down. That's what I think everyone's kind of thinking. I think if they do 75 basis points, maybe people kind of do the same thing. I think if they come out and do a full percentage, then I think maybe SPY would go up, because then it would show that they're serious. But I don't see them doing that. Yeah, I don't see them doing that. I don't think they have the. I mean, I don't think this dude gets it. I'm gonna put it right out there. Yeah, here he is from this morning. See, he's what they call a Keynesian. There's Keynesians, there's monetarists, and there are Austrians. So monetarists focus on the money supply. Keynesians focus on demand. I think the Austrian school does a little bit of each, but because of this, they don't pay attention to the money supply, and that's one of the main things that drives inflation. So in their mind, oh, prices are going up. It must be because the economy is doing so well. That would be what we call demand pull inflation. It must be. That's the only possible reason why it could be going up. And he was wrong. They should focus on money supply. They should focus on all of this stuff. So that's why they overstimulated the economy. And we go back to this guy here. I don't have it here in this little call out here, but when he got this whole thing here where the Financial Crisis Inquiry Commission, that's after the blow up in 2008, when put out its conclusions, he's a big follower of Ayn Rand, right? I don't know what you would call her. It was a libertarian, Ayn Rand, when Atlas Shrugged, the book. So anyway, because he believed in the theories of this book, I know that sounds incredibly hard to believe, but it's true. He made all these bad decisions. He didn't use enough regulation. He kept interest rates too low. So I guess that's a long way of getting to your question and saying, no, I think it'll probably go down. If they came out at 1%, I would think it would go up, but I just don't think they're going to do it. I don't think they have the, it's so stupid too, because they could do inter-meeting moves. They could come out whenever they want to raise rates, They don't have to wait for these meetings to do it. Maybe they say, hey, we're going to raise rates 25 basis points every week for the next 4 weeks. Do some kind of like creative thinking there, and if the markets really start to freak out, say, hey, we're going to pull back. It doesn't have to be at the monthly meeting. So you're welcome, Chicken Blue.
Really quick, guys, for those that are asking how you can join the trading school, all you guys on Twitter know that it's posted there on the link on the top part. You could see it's a link, $7 for 7 days. That's your trial period. After that, it's $14.97 for the year if you want to keep it. And for all you guys on YouTube and Zoom, It's going to be in the chat, but we're going to bring on Mark here in a little bit. We're just waiting for him to wrap up the session here.
Truck driver shortage is BS. It's just companies don't want to pay drivers. Yeah. FMOC was yesterday's news. Yeah, I mean, it's like, dude, no one's going to listen to what these guys say. It's like, but I think that the market's probably going to remain quiet until we see that. I mean, if you look at SPY over here, I mean, we're really just, it's just like almost kind of like a non-day. All right, guys, I didn't realize that we went so far past here. I gotta hit the road. All right, everybody, I'll talk to you tomorrow. Thanks, everyone.
All right, guys, and Mark's going to be right here with us here in a little bit. We're just waiting for him to get on the link. So for all you guys that have been waiting to pretty much get a hold of Mark, just know that we're going to have him here in about a couple minutes. He has the link. He's going to be here with us live. For all you guys, students from the school, good to see you here again, guys. But yeah, just give us a quick minute here so that we can get Mark all settled in. 1 second, guys. All right, folks. All right, let me just double check here. So yeah, Mark Putrino. So Mark Putrino is a former hedge fund manager. For those that don't know, he's traded with Mario Gabelli, Steve Cohen, multi-billionaires pretty much, and he's been a market maker, hedge fund manager. He's done a lot in Wall Street. He's been there for about 20 years. So, but he is focused on the Benzinga Trading School, which is pretty much helping retail traders, learn the ropes around the markets and all that sort of stuff. And we have about 8 chapters. Classes are Monday to Friday. And you guys know you do get the research terminal, Benzinga Pro, that we have. So that's pretty much included for all you guys. And in the meantime here, looks like Mark's there. He's just finishing getting set up. All right, folks. So just give us a quick minute here while we get Mark set up. All right, there we go. I think we have him in the building. Hold up. I need to just get everything ready here. Okay, so we have here former hedge fund manager, lead trader from the Benzinga School, Mark Putrino. All right, so we're going to bring him in here now. He should be there set up and good to go. Let's get this party started, Mark.
Hey, Rodrigo.
Hey, man. I was showing the folks here for everybody that's been on the Twitter space watching on YouTube and everywhere else. Here we have Mark Putrino, right? So a lot of you guys know him from the trading school. Some of you guys know him. Well, I mean, he's got quite an extensive background. He's traded for people like Mario Gabelli, Steve Cohen, multi-billionaires out there. And, we're lucky enough to have him here in the trading school where he's been able to really help out a lot of traders out there. So, Mark, we saw the class a little bit, from what happened there, but Seemed pretty interesting what happened with energy, what was going on with the energy side, with whatever that explosion was or something like that in Europe.
Yeah, well, there's a big move lower in natural gas. And I think the reason why is because we had this big fire, right? But an explosion, but the explosion was at an export plant. So my guess, and this is just a guess, I don't know this for sure. My guess is that the gas that was going to get exported into Europe is now brought back into domestically, because natural gas in Europe is up, but natural gas here is down. So Rodrigo, I'm going to take over the screen and just so everyone can see, if that's okay.
Yeah, let's go.
All right, so this is what I mean here. So this is natural gas. All right, so we can talk a lot about the trading school, just within what we see here, because it's like every chart we look at can teach a different lesson. And if you don't trade natural gas, don't worry, because there are ETFs that you can use that you can profit from this, that you can use to profit from this. So this is this big move lower, for example. This is today we're down about 13%. So it's counterintuitive. You hear explosion. We think things should go up, but it turns out, oh no, it's going to bring more gas back onto the domestic market. So we make this big sell-off here. Now, where did we find a bottom today? Right around $7. Why is there support at $7? Well, I don't know, but it was support back here. And a lot of times when a level is support, the importance stays intact for a while. That's what we call, if you've ever heard the term like the market has a memory, market memory. That means support can stay intact for a while. So if you were trading this and you knew that the support was at 7, you could have gotten the exact bottom today. You also could have seen this support up here that was clear. And a lot of times when support levels break, things tend to make big moves. Support is a large group of buyers that are looking to pay close to the same price. So when a market's going down, like here, when natural gas was going down, there's not enough demand or buyers to absorb everything that's for sale. And it works out the same, any market there is, stock market, crypto market, there's not enough demand to absorb all the supply. So sellers are forced to push the price down if they want to get stuff done. They almost have to sell it at a discount, and that forces us into this downtrend. When we get down to a support level, there's enough demand to absorb all of the supply. So a lot of times the trend changes there. Now the sellers can sell all they want to. There's enough buyers to absorb it all. And that gets the market moving higher because people realize that there are buyers around. Now, once the support breaks, it means whatever we're looking at trades below it. It illustrates something. We have to look at all of these charts in the context of supply and demand. And if we break, we get below a support level, well, it tells us that the buyers who created the support are no longer in the market. They've either finished their orders or they've canceled their orders. Regardless, they're out of the way. So when you have a lot of demand out of the way, once again, the sellers are forced to accept lower prices and they have to push it down. So big signals come when things break support or they break resistance. So you could have gotten into this trade today, right when it broke 8, or if it got to 8 theoretically, because you could have seen, all right, well, support's breaking. There's a good chance it's going to go lower. I don't know how low we would have if we thought the move would have been this big. Then you could have said, all right, well, if it gets to 7, I'm going to cover, and because that was support. And the way you can profit from that is using an inverse ETF. This ETF, the symbol is cold with a K. It's designed to move inversely in twice the direction of what natural gas does. So today, this thing is up 31%. It's up $6 and it's trading at 27. So trading is there's a lot of different tools that we can use now. And
basically, Mark, just so everybody can kind of grasp it here, because we have a lot of new students here, but also people that want to join the school. just to give them an understanding here. So in the trading school, not only you have, you have classes Monday to Friday, you have a bunch of live rooms that, ask Mark a question, or, Mark's trade ideas, where Mark's posting his setups, interacting with the community, but you can learn and trade at the same time, right? It's not just learning. Is that correct?
Yeah. Yeah. I mean, people can do whatever they want. Well, yeah, a lot of those students are trading, like as we're in the class. Um, some of them are very active and they tell us what they're doing. I would imagine there are some people who have been on the sidelines who don't want people to know, but we have a very active crew of participants. A bunch of the people that came out to Vegas, and they're good at helping the newer students. So it's a good community. It's a good community, and to be perfectly frank, with everyone and you, Rodrigo, when I first considered doing this, my background is in the institutional community. I didn't even realize this whole like retail community thing, how important it was to some people. But now that I've seen with a bunch of the students how important it is to them, we're really like cultivating it. And then some of the students are breaking off and forming like study groups. And we had a couple of people maybe talking about trying to build a particular indicator or oscillator. So it's a lot of interaction. It's not just me droning on and on. A lot of it is a lot of our best ideas have been student trade ideas. Every day we learn something. Today we had a new student who's a truck driver, was giving us a little bit of insight about what's going on in the trucking industry, because we're talking about gas prices and how high diesel prices are getting. So there's an active community. We got pretty much experience levels of a whole range of things, but it's people that they come to the school because they've lost money. And today is well, that's not 100% true. A couple of the people have never traded before and they want to start trading, and they've joined, and now they don't have anything to unlearn. But a lot of the people, I would say the vast majority, come because they've lost money. And when I say, well, why did you lose money? I always get like 90% of it as, well, I guessed, or I didn't follow a plan. So out of our 8 classes, one of them is investment psychology. And that's the class that we had today. So if someone was to ask me, what is the number one thing you can tell someone about trading? Like, what's the number one thing that's the key to success? It's this. It's understanding that as humans, we haven't evolved in a way that's conducive to trading. The concept of losing money makes us panic or makes us feel fear. And when we feel fear, we tend to do dumb things. We make emotional decisions. So, so when we feel fear, we make emotional decisions. And that causes people to do the 2 worst things that they can do. Is they from a trading point of view, you buy something and it goes down, and instead of getting stopped out for a small loss, you hold on to it because you're afraid to take a loss. You're afraid. It's emotion. You buy something and it starts going up, and you say, all right, I'm going to hold it till it gets to 20, but it gets to 18, and you should decide, oh, I'm going to sell it, because you get afraid that it's going to reverse and you're going to lose your profit. And then you watch it go to 20, and you second guess yourself and say, hey, I should have waited. But that's the reason why people fail. And there's no one right trading system that works for everyone. You got to do what fits your personality, your time frame, your practical things. Like if you're an emergency room doctor, you probably shouldn't be a day trader, right? Some trades, all your trade things start going off, right? Like when some big accident happens or whatever. But the commonality amongst all the various things and people that are successful is their understanding of how important this whole investment psychology thing is. So that's one of our classes. Another one of the classes is on price levels. The classes go over what I would say are 7 or 8 basic market fundamentals, which I don't think are going to change. There's always going to be important price levels that there's always going to be some price levels that are more important than others. So that's why we're looking at all these levels. By knowing where the levels are, you get the idea as to where the market's going to turn. We have a class on patterns. A lot of people like patterns. I think that most patterns are a little, I don't know, I don't really use them. I think some of them are silly, but I think some of them have meaning and validity. And one of them is, we can see here again in this whole natural gas chart. This is what we would call the descending triangle pattern. And this is what we would call the ascending triangle pattern. So for reasons that are pretty apparent, right? This is, well, this descending line, and you can just imagine that that's a triangle, and that's descending line, and you can imagine that that's a triangle. So this shows market psychology. Charts are not astrology. Charts are not tea reading if done correctly. I mean, to some people they are, because they're into some weird, bizarro stuff. But if done correctly, charts reading should be a study of the supply and demand dynamics in a market. So the descending triangle is bearish, shows that as time has gone by here, buyers have hung out around 481. They've been like, all right, well, whatever. You know, if they come to me, they come to me, I'll buy it. If they don't come to me, I don't care. I'm just going to hang out at 480. The same time, as time is going by here, we have our sellers getting more and more aggressive. They're willing to accept lower prices. As time goes by, they're knocking it down. So when you have this combination of aggressive sellers and complacent buyers, it sets the stage for the market to go lower. Sure enough, that's what happened. The support broke. This told us that all these buyers that created the support are gone. So the market goes and falls. Now we have the opposite, the ascending triangle, where we have complacent sellers. This was a little bit of an anomaly. I don't know what happened here. It got up and it came right back in. So let's just, for our intents and purposes, pretend that's not there, because it's still the same dynamics. So we've had these sellers hanging out around this level here, around 480. But at the same time, as things are going by, as time is going by, buyers are becoming more and more aggressive. They're willing to pay higher and higher prices, right? So now we have the opposite. We have complacent sellers, aggressive buyers. That sets the stage for the market to move higher. And it doesn't matter what market it is. It could be the real estate market, you know, the crypto market, options market. That's when you have aggressive buyers and complacent sellers, it just sets the stage for the price to move higher. So it all kind of ties in, Rodrigo. You know, we talk about psychology, but chart reading encompasses psychology as well. We're looking at mass psychology here. We're looking at buyer's remorse. We're looking at seller's remorse, support. So, and I can understand why people are confused about the market and about all this stuff, because frankly, a lot of the people that are out there in the public, at least that I've seen, and I'm talking about even some like the well-known people you might see in the media, they really don't know what they're doing. They don't understand this. And I think the reason why they don't get it is because they've never actually traded. They may have read a bunch of books and stuff, but they've never been out in the trading world. You know, I mean, I was in the trading world for like 20, 25 years. So, you know, sometimes you just pick stuff up when you do it enough.
Right.
So yeah, so just by focusing on these levels is a good way to really get started, Rodrigo, for like
And
coming
no,
up.
yeah, that's absolutely true, man. And that's the thing. I think every trader should start with the trading school instead of trying to learn by blowing up your account. But so look, I'm getting a lot of questions here and emails about the folks about the school. So let me just answer a couple of these, Mark, and we'll get back at it. All
You
right.
want me to give you the screen back?
No, it's all right.
Okay.
So, all right, folks. So good. Thanks a lot for these questions, by the way. We're going to get through them really quickly here. So does Mark Putrino go over student trade ideas during the live sessions? Yes, that's very standard. It happens all the time. Are the sessions recorded? Every single session is recorded. So the 7 to 9 a.m. session and the 12 to 1 session as well, and as well as any other bonus material and content that you guys get, right? And that's Eastern time. Good question there. Does everybody that joined get a free laptop? Yes, after the 7-day trial for $7. Once you join for $14.97, you will get that laptop. It's courtesy. So yeah, technically everybody that comes in through this trial. Let's see, is this for new traders only? Not really. We do have some advanced traders there as well. Keep in mind, Mark Putrino is a former hedge fund manager, traded with Steve Cohen, Mario Gabelli, people that manage billions of dollars. So some people get in there just for the trades, other people for the education, some people for both. It varies, but that's a good one there. What is the schedule? All right, so the live classes are Monday to Thursday, 7 to 9 a.m. and 12 to 1 Eastern, and then Friday, it's 7 to 9 a.m. Eastern. However, the live trading rooms, the live chat rooms are open 24/7. All right. Is there a money back guarantee? Yes, 7 days. And price at renewal is going to be the same, $14.97. That's per year. So I think that covers everything. Most of the questions here, unless you want to add anything, Mark. I think you're doing something different there with the sessions, that you have like a weekly review presentation, something like that.
Yeah, it's like a weekly newsletter that I put out. That's kind of, here's what we here's this week. So just talking about inflation. This is more of a just like a what to watch in the week ahead, and I'll show you. So this I wrote over the weekend. So this is kind of just like some fluff to be a little bit entertaining. We're talking about inflation, and this is the Zimbabwe inflation. A little bit of history, and by studying history, it helps us understand the markets in current time. But this inflation got up to where it was literally 98% a day. And the reason why it happened was because they were just printing money out of thin air to pay all the bills. Sound familiar? I mean, I don't think we're ever going to get like that here. A little bit about what is inflation. This is what I was talking about before with the demand pull, cost push. These Keynesians that we have, and they really just focus on this. They don't focus on this. That's why they were so wrong. Because when they say, oh, prices are going up, it's got to be because the economy is good. They don't think like, oh, gee, maybe prices are going up because we pumped out too much stimulus into the economy. So that's why they have it so wrong. They need to really change the mindset.
Right.
Just like Greenspan was so wrong with following Ayn Rand's.
Man, I really find it hard to believe that these people didn't know. They must have known and just kept on doing their job. There's just no way they're that stupid. It's just I don't see it.
No, they're pretty stupid, in my opinion. I mean, hey, look, man, one of the things I've learned in my life is there's some pretty stupid people in some pretty important positions out there. You know, it's right place at the right time. Better to be lucky than to be smart. You know, I mean, I wonder how many tens of millions and millions of dollars Warren Buffett's assistant has, right? So just a couple ways to profit from inflation. A bunch of the students bought this. This ETF is up 50% year to date, right? People think, well, the market's melting down. Well, parts of the market have been going up. You know, most of the market's been melting down, but there's been strength in commodities. So this thing is going to mirror this commodity index. So as long as inflation keeps going up, this is going to go up. It's an ETF. It trades just like a regular stock. I think it's a good hedge for people that think we're going to have much more inflation, and I think we are. So I still think that's probably a good buy at this opportunity. Energy stocks will also go higher. So this is like, how do we make money from inflation instead of like putting our head in the sand and hoping it goes away? We can look at commodities companies. We can look at energy companies. And then this is what I was talking about, how, you know, we kind of anticipated yesterday's move lower because, you know, the SPY closed right on support on Friday. Technology was right at support. It's not too often. Well, this is SPY, right? This is the broad market. Now we'll look at some of the sectors. It's not too often, and this is our class tomorrow, is how to look at the broader markets to see where the main market's kind of going to go. But anyway, so we have this sitting right at a clear support level. We had that's Apple. Healthcare was sitting right at important support. Financials are right at support. Materials were right at support. Industrials. So it's not too often that you get so many of these different things lining up. So I think this is 6 sectors, which add up to be 70% of the market. We also talked about this potential breakout, and this is absolutely unbelievable now. 10-year yields are up to, I think, to like 3.4 now. So this is breaking out. 10-year yields are up like 10% in just a week. I mean, this is really getting, this is oil. These are talking about inflation, like this guy screwed up, he's screwing up. So yeah, so that's what this is, but this is really frankly pretty concerning. I mean, with this 10-year yields, it's not necessarily the size of the move, but I'm sorry, it's not as much of important to think about where we are historically, because a lot of people are going to say, well, rates are higher, but they're still below historical. But I think it's more important to consider the rate of the change, the speed of the change, because for some reason this index used to go back to 1963, and now it only goes back to 1994. But if you looked at it from a long-term perspective, like there's nothing even close to this type of a move higher here, nothing even in the ballpark. So let's see. So three. All right. So today is the 14th. So on June 10th, we were at, well, let's go back a couple more days. So yeah, this is pretty frightening, man. So we're up 15% in 3 days. This is like full scale market meltdown, market meltdown, fire and brimstone type of a thing here. And that's,
Mark,
yeah.
What do you think rates will do to let's just say the energy sector, and mostly with what's happening alongside with does it have to do anything what's happening in Ukraine, Russia?
Not as much as people think. That's one of the things where people get confused, because the media is so wrong about things, and I'll just give you a perfect example. And this is why it's good to look at the different sectors to give you insight into what's actually going on. So this is the broad market, the S&P 500. So the market's going down in here, and all we're hearing about is, problems in Ukraine. This is where Ukraine starts, right here. Right? Market's down because of Ukraine. Well, then why did the market start going up when things started getting to look even worse in Ukraine? And the reason why is because if we go into our technology sector, we find that we were getting to a level that had been resistance in the past, and levels that were resistance can turn into support. So this is Ukraine. The market turned because the biggest sector in it found support. It had nothing to do with Ukraine. So the vast majority of stuff people hear in the media, Rodrigo, is it's wrong. So it's like, shut it off, man. No watching CNBC, any of that kind of stuff. We're just going to confuse you. Just keep it simple. Focus on our levels. Focus on our momentum, and that's the secret, man. That's ignore the
goal,
gurus.
right? That's the goal of the trading school, like to teach individual traders to find opportunities and take advantage of them instead of because I get it. A lot of people start they make that mistake of they buy and trade what's on the headline on CNBC, but ultimately you get burned by trying to find the shortcut, the secret formula, right? The holy grail, as you say.
Yeah, I mean, I want people, the idea here is for people to learn how to come up with their own trading ideas, different ways to go through the market, because what fits one person isn't going to fit another person. You have to do what's in your personality. I mean, some people like to do, long-term buy and hold. Some people are day traders, scalpers. Some people only trade particular stocks. Some people trade a whole variety of stocks. So it's a school, it's to educate, it's to learn. It's about exchanging ideas, talking to other people. Some of the best ideas come from the students. It's not like, oh, here's our trade idea of the day. It's, it's like, let's go through the market and we'll see what we can find. And maybe we could find a whole bunch of stuff. I mean, we always find something that looks pretty interesting. Markets like the way they've been. I mean, it's like there's tons of stuff that's been going on. That's why a lot of the students said that this was their best day ever on Friday, right? What's today? Tuesday? Yeah, on these 2 days are Thursday and Friday. Because what happened? Well, we had the breaking of a clear level, and we had a bunch of them use the triple ETFs or the triple inverse ETFs and bought calls, and we got down here, and this was our target because it was a former support level. Now we followed through since then, but I would imagine a bunch of them probably got in on this when we started to break here. Well, actually, maybe not, because we actually opened up down here. But yeah, it's just by watching, just by knowing where these important levels are, and knowing what are the tools that you can use to get exposure to them, and understanding the investment psychology part of it. Like, that's the secret. It doesn't need to be complicated. It doesn't need to be like, oh, you got to do this secret formula or higher calculus or get a PhD in statistics. I mean, think about this. All these big, well, not all of them, but as far as I'd be willing to say, the vast majority of these hedge funds that were formed to take advantage of artificial intelligence 4 or 5 years ago. I mean, 4 or 5 years ago, that's all you heard about on Wall Street. This fund uses AI, this fund doesn't use AI, this fund does it. But all the AI funds, I mean, their performance is abysmal. Well, again, I don't want to say all of them, but there's a benchmark that tracks the performance of the funds that are driven by artificial intelligence. And I think the average one was up about 9% last year, whereas the overall market was up about 27 or 28%. So it's a perfect example, Rodrigo, of why, just because it's complicated doesn't mean it's good.
Right. And that's the thing. A lot of people usually, they will try to find some sort of holy grail, some sort of shortcut. And usually that's when some people get, kind of like stuck into that. And how have you seen, Mark, some of these traders in? I mean, it's from international community, right? You have people from all over the world there.
Oh, yeah. Yeah. We have people from all over the world. Hawaii, Europe, Asia, India. Yeah, I mean, the entire world. So it's a pretty fun class. The only real prerequisite is it's just got to be people that want to learn. I don't want people that want to be told what to do, because I don't know what to tell you. I mean, in a lot of situations I do, but I don't really, if I don't know your personality, there's no one size fits all trading style. You know what I mean? People find stocks that it fits their eye. I like to say all stocks have like a different personality. So two different traders might look at a chart and see completely different things, and they might both be right. Because it depends on their time frame. It depends on the trends that they're trading.
Right. I mean, this could help you even, man. Like, I mean, in my case, when I trade options, I mean, this helped me a lot with better entries and exits. So it helps you even if you're just buying either, doing options or crypto, whatever, right?
Oh, yeah. Yeah, this is, yeah. Like, if this starts to break down here, it's going to be telling us, I think, that we want to go lower. So I think right now we're kind of in a wait and hold position. But yeah, when you start to see these big levels break, then that's where big movements come. And then that's where you jump in to trade the options. So I think,
right. So, I mean, a lot of oil stocks, or some of them, I mean, oil seems to be ripping, but like maybe not all the stocks are going. I mean, is there any particular reason you think so?
well, it's there's just some profit taking because oil is testing resistance. So, we had talked about in the class how if oil gets up to these former levels, there's probably going to be some profit taking in the stocks as we consolidate here. And that's exactly what's happening. But my guess is that we break and we keep going higher. So I think those stocks will kick all back in gear here.
What do you say about people that I mean, look, I wouldn't be surprised at this point, but like, what do you think about let's say oil in it hitting like 200 a barrel or more?
I don't know if it could get that high, because I don't know if the economy could sustain that. You know, I mean,
From
if you do that, you're talking about, you know, the average price of gasoline in this country being over $10 a gallon.
I mean, didn't we start sending $400 checks to people for gas? Like we're subsidizing a lot
Yeah,
of
it's a real messed up situation because a lot of this stuff is, you know, it didn't come out of the blue. It's almost, you know, a big part of it is just the result of the energy policy, the change in the energy policy. But it has real consequences. You know, it's like it causes wars and famines, you know, like literally. But I don't know if oil could get that high because I think the economy would just come to a screeching halt before it got there. Like
Well, I
maybe it
mean,
gets to
okay,
like
so
150.
okay, so if oil were to stay at 120 solid, right? Solid 120 or higher, let's just say, I mean, would oil stocks would still be doing fine, right? At that price level. You think so?
Yeah, yeah. I mean, if oil stays steady, the stocks will stay steady. Commodities-based stocks like oil company stocks or, you know, gold miners or, you know, whatever, they're different than regular stocks. And the reason why is because ultimately they're going to follow the price of the commodity. You know, ExxonMobil here, you know, there's some profit taking because oil is trading, you know, sideways. But if oil kicks back into gear, and I suspect it will, this is going to eventually catch up with it. And the reason why is because, you know, an oil company like ExxonMobil, think of their main assets. They have these big tanks of oil all over the place. And if the value of that oil goes higher, then the value of the company goes higher and the value of the share price goes higher. But I personally, I don't see how oil could get to 200 without us going into like a new Great Depression, because it would just be like, you know, people want it, stuff would be too expensive. Like you wouldn't be able, no one would be buying anything because everything would get too expensive.
Yeah, I mean,
So
they
let's
want you
hope
to
that
buy
doesn't
an
happen.
EV.
But
Yeah, I mean, not everybody can buy an EV, right? I guess.
yeah, yeah. And in our country, people drive a lot, you know, or it's some people say, well, in you know, in Britain, it's equivalent to like $10 a gallon and so forth. But you know, they don't have these truck drivers that are driving thousands of miles across the country because the country it just isn't as big. Um, so yeah, and this whole electronic vehicle thing is ridiculous because I mean I'm not gonna say it's ridiculous, but what about like where do you dispose of the batteries? You know, isn't that bad for the environment? You know, to run the electric grid, don't you need oil to run the electric grid? So I don't know. I don't see that like, you know, I just don't see that like everyone could go out
I
and
mean,
buy a $60,000 Tesla tomorrow, you know?
If it gets to $10, we're just gonna everybody's gonna get a bigger check for gas. You know, then we're gonna start sending red checks. I don't know. I could see it happening. I don't know, but
It's yeah, they do, man. They send it. Look, man, I you know was getting I think $411 a month for my child credit. It's like, why are they giving it to me? You know, I mean, they should. I mean, don't get me wrong, I didn't send it back, but you know, it's just like they should target people that need it as opposed to just throwing out this blanket money to everyone and paying people to not work. And here we have here we have the results of it. We have this monetarily driven inflation. Oh, look at
yeah.
this. U.S. Senate to propose 21% surtax on excessive oil firm profits. So what would be excessive? I guess that's in the word. You know, what is your definition of excessive? But I'll tell you one of the things that's going on here with oil. Well, there's a couple things. One is they're not drilling more because the regulatory environment. I mean, why would you go and drill or build a new pipeline if you think there's a chance that in a year you might get shut down or they might change the law, right? So that's a big part of it. Another part of it is this here. This back here in 2014, 2015, this is what was called the shale crash, right? All the shale came online and it just drove prices lower. So from 2015 to early 2020 or 2021, it was not a good time to be in the oil industry. This was a good time. This was a not good time. So they're a little reluctant to try to have something like this happen again, right? So there wasn't this like, oh, let's take advantage of these high oil prices. But you have to remember, ultimately, they make money by selling oil, by selling it, not just by holding it. They have to actually sell it. And if it gets too high, they don't sell as much. So, I don't think that there's all these people sitting around saying, these boardrooms at ExxonMobil saying, oh, gee, let's figure out how we can make oil go higher and higher. I mean, ExxonMobil has 80,000 employees, and I would imagine most of them probably drive to work. So it's affecting them as well. But yeah, so that's what's going on here. But so this was the shell crash. This was the what I call the pension plan performance chasing thing here. But yeah, I don't see how we could get back here. When oil was here, Goldman Sachs made this infamous call that it was going to 200, and months later it lost 2/3 of its value.
So that's the level, the 140. That's the
Yeah, I would say, yeah, I think that, I would say if we get to around 140, and this is the whole market memory thing, and it's hard to believe if you didn't see it, but sometimes these levels can stay intact for months, if not years. So this is the energy ETF, and this is one of the things that told us that there was a good chance that these oil stocks were going to go higher a few weeks ago. So let me go to this. Now, when things surpass important levels, they tend to make big moves. So look how clear resistance was here at 78 for XLE back in 2016, 2018. And then if we go to the shorter term chart, you can see how so this is the shorter term chart. Now this just goes back to the beginning of the year. So when we got to 78, what did we do? We hit resistance, right? So this is like resistance that goes back for 6 years. Yeah, so I don't know. I think that's kind of the story with energy. It's going to get worse. It's going to get worse before it gets better. I mean, now they're even talking about these food shortages and Ukraine. It's look, if oil wasn't up this high, Ukraine would not have been invaded because they use oil money to finance it. It's pretty simple. And now you got famines breaking out in parts of North Africa and the Middle East because wheat prices are so high. So it's a pretty sad state of affairs. But all that being said, Rodrigo, as traders, we got to keep our heads clear and level, and let the market tell us what to do. And that's really ultimately where the profits come from. It's by letting the market tell you what to do.
It's an interesting way to, well, just based on everything that's happening, because you have technical levels, but then you have also like outside factors, external factors, and just seeing that play together. It's just pretty interesting on the charts with energy, with oil companies, that sort of stuff.
Yeah, I used to work with a guy who was a really, really, really smart guy. One of the smartest people I've known in my life, actually. And he was a money manager, and he never looked at charts. I mean, he did after he worked with me for a while, but that wasn't his thing. He was more into like really like deep analysis of the economy, and he used models, but he wasn't a chart guy. So when we first started working together, he wasn't really like reluctant, but if I would go to show him, hey, look at this on the chart, he'd be like, okay, like whatever. But as we worked together for the year, a year or two going into it, he would be like, hey, what are you thinking now? Because he's like, everything I see is on this particular stock is telling me to buy it. What would your chart tell you? And I would look at the chart and be like, oh, it looks like a buy to me too. It's oversold and it's at support. And it's this whole chicken and the egg thing, right? But sometimes mysteriously, these things all kind of come together
at the levels, right? It's like the speech of the Fed or whatever. It's always at a certain technical level. Like it's almost, I don't know, too close.
It's inexplicable, and I've been thinking about it for
charts
a long time. And if you think about it too much, you'll drive yourself crazy.
They're probably
because
looking at the levels too, man. Like, it just hit.
but at the end of the day, it always comes back to the default setting is going to the chart, because the charts don't lie. The charts will never lie. Politicians lie, analysts are wrong, but the charts will never lie. So that's why we let the market tell us what to do and we don't guess.
Yeah, and there's this so like, all right, so like as like Russia, they have a lot of oil and gas, all that stuff, and they used to have deals. I mean, they're still not 100% banned from all of Europe. I think like 90%, something like that. But I mean, they used to provide a lot of energy to all of Europe, right? And since the sanctions and all that stuff, there's going to be a lot of rerouting of oil, right, from one place to another, because you can't buy from Russia anymore. You need to get it from somewhere else. So there's the way I look at it, man, that's like the like the gold rush, but for like certain oil companies. Like there's a small company, IMPP, but they're in Greece and they're like fully exported. Keep in mind, it's a penny stock. It's like 60 cents. So it's super volatile. I just saw it, and because I saw that it's in Greece, and I'm like, oh, that's very interesting. Maybe this stock is able, they reported earnings, it was good. But it's just really interesting to see how the entire oil game is going to change in Europe 100%, based on everything that's happening now.
What's
like
the symbol on it?
IMPP.
I am Imperial Petroleum.
Yeah.
Yeah. Huh. Yeah, I mean, yeah, there's a reshuffling going on. There's no doubt about that. But I was reading, I don't know if I saw it in the journal today, that we're actually still buying oil from Russia. And what they do.
Yeah.
Well, here in the United States, I think they're stricter in Europe. But what they do is they the Russian ship goes out and meets another ship in the middle of the ocean, and then they transfer the oil out at sea. So when it comes in, it's coming in on a ship that's not coming from Russia. I thought it was in the journal. But yeah, these big changes lead to opportunities, so it's an unfortunate thing with what's going on with oil. But I mean, there are commodities traders that have made a fortune over the last 4 months. Everyone's watching the stock market, but these commodities traders have just been crushing it.
And I think before this, we were even talking about Husa. That was another one. But like, there's just a lot of opportunities. And here's the thing: in the trading school, it doesn't matter what you're trading. I think we were talking about it. Well, I got in there like around $4, but I'm not in it anymore. But I just see a lot of opportunity and energy, a lot of the reshuffling happening around the world, specifically in Europe, because that smaller penny stock is in Greece. So, but yeah, it doesn't seem like oil is going to stop anytime soon, Mark, right?
No, I think it probably goes to about 140. So another $15. But it's a commodity. So what will slow it down? What will keep it from going higher? Well, when it gets high enough that people stop buying so much of it. People make these little changes. Like for example, I haven't done anything like dramatic now, but I'm making sure that like when no one's in a room, the lights shut off. You know what I mean? Or making sure the TV's shut off. So little things like that. I mean, I don't know how much it's going to really reduce my energy expenditure here in my house, maybe 2 or 3%, but people start doing little things like that, and it starts to kind of cascade, and it ends up resulting in less demand, and that's what drives prices down. But all that being said, I think we got some more upside. I mean, certain things are going to need to run, right? You're going to need fire trucks, you're going to need ambulances. But yeah, I think we get up to around 140-ish, and I would be expecting a top there because that's the historical top.
Right.
But yeah, that's the conversation with when they talk about the hard landing or the soft landing. It's inflation can get really bad. It can really get out of control. So when they talk about a hard landing, that's what they do is they just jack up rates to force the economy into recession. And then people just stop buying oil because it's a recession. And then that brings the price down. That's what they did in the early 80s. The soft landing is what they try to do is they think they can raise rates and not cause the recession to happen. But I would be willing to say that parts of the economy are in recession already.
Why do you say that?
Well, because we're seeing the higher inventories in was it Target, Walmart. They're building inventory, which means they're just not selling as much stuff. Something that was really kind of alarming, which I didn't hear anyone else other than me talk about this. SP. Where the heck is it? Well, Standard & Poor's is a bond rating agency. Let's just see if I can find the article. Well, Standard & Poor's is a bond rating agency. They're not just, they don't just maintain these indices. Standard & Poor's Global, or is it S&P Global? Let's see. This is pretty important. Okay, here we go. Now this is pretty important here, and I haven't heard anyone else mention it. So June 1st, and we're at June 14th. So this is 2 weeks ago. So S&P goes around and they go to other companies and they rate their bonds. You know, if you have a company and you want to have a bond offering, you would contact someone like these guys and say, hey, can you come rate our bonds? And then when people go to invest, they say, oh, these guys are AAA rated, these guys are AA rated. And corporate America needs the bond market to survive. People aren't just taking money out of the register to go cover their day-to-day expenses. They're borrowing overnight, or they're having these short-term bonds issued, or short-term bonds borrowings that they're using. So anyway, this company that rates this says that they're going to withdraw their earnings guidance, because basically they're saying things are getting so bad that they just have no idea what's going to happen. And they're saying here that rated or billed issuance could be 30 to 35% lower than last year. All right. Leverage loan volumes could be 40% lower. That's basically saying that there's going to be, you know, the business coming up is only going to be 70% of what it was, or 60% of what it was. So this is a pretty negative story that a lot of people aren't really talking about. But, you know, this just shows you that things are really getting kind of crazy. And then, you know, you had Jamie Dimon saying he sees the economic hurricane. And Jamie Dimon isn't just some guy in the street. You know, he runs the biggest bank in the country. So he talks to the investment bankers, he talks to the clients, he sees what's probably going on in the retail clients' accounts. So a guy like him has pretty darn good insight into what's going to happen. He says something like that. You know, I saw someone on TV say, oh, well, you know, even his own economists don't say there's going to be a recession, but they're just missing the overall picture. You know, what if maybe Jamie Dimon saw something where it's like, oh, gee, our you know, deposits for customers, or customers are withdrawing money instead of depositing it. You know, up until 2 weeks ago, it was net deposits, but now that money's going to, I mean, I don't know. I'm just talking off the cuff, right. But he clearly saw something that he didn't like. So, you know, then we had the head of the EIA, the International Energy Association, say that there's going to be shortages this summer that are going to be like the late 70s. So yeah, so there's really nothing to be bullish about at this point.
I mean, so let's just say if China opens, that would be good for oil.
Yeah.
If they reopen. They haven't reopened. So here's what I'm thinking, that right now we're at 120, 122. China is not open. They've been shut down for months. Once they reopen, basically that would be do you think that would be a bullish sign for oil overall? Because I think I think they're buying all that oil from Russia. I mean, let's be real. They're buying that oil.
Yeah, that would put upward pressure on oil. There's no doubt about it. But it's hard to get transparency out of what's going on over there. So, but I guess one of the things we can do is we can look at the Chinese markets and see if they've started to recover. And
yeah, I mean, it's just because I mean, I was even reading on the news that, like, I mean, they were selling it to them, or that they were just selling it as oil from somewhere else, and like, who the hell checks? You just put a label on it, you know?
Yeah. That's what's happening. Changing the stuff out of sea. But yeah, I mean, this is the Chinese stock market, which we keep an eye on. And it's it doesn't look like it's really recovering at any point. So I would imagine this would probably turn before what's going on over their turns. So we will get a little bit of a insight here, but it doesn't look like that's happened yet. So I would say that they still might be a little bit off. Yeah.
Right.
So I think that would add to the inflationary pressure. Absolutely.
It just seems that, like, this could be, I just see everything right now just lining up as the perfect storm. Because right now, like, I saw rates went up to like 6% on mortgages. So, I mean, the way I look at it, man, is that people have way less money in their pockets spending basic stuff like food and gas, and then they're getting squeezed everything else with their higher interest rate payments, either on their mortgage or their car. So I don't know how that doesn't translate to maybe people. I don't know, maybe down the road, if things get really bad, then foreclosures and bankrupt people, are unable to pay their cars and houses. And there's even like high numbers of like auto repos recently. So I don't know, dude. So people were saying this could be like a black swan. I don't know, of a lot of things.
Well, yeah, it could be, because we would have saw this before coming 2 years ago, because it's largely self-induced. It's not like coming from external sources. I mean, in my opinion, everything that's going on right now comes all right down to the fact that we're just not producing enough oil, and everything else is tied into that. And yeah, I mean, it's serious stuff, dude. It's like I called, or we have oil heat here at my house, so we got a delivery. So I called up to pay, and I'm talking to the guy, and he's like, they got a lot of people that can't afford to pay their bills, and this is the summertime. I mean, if this stuff isn't a little bit better going into next winter time, then what happens when people can't afford to pay for heat? It's pretty messed up, dude. It's pretty messed up. It's not just, and then what's going to happen. Then they're going to be like, oh, we're going to have price controls, right? That's going to be the answer, is price controls. And that's going to make stuff even worse, because they're not letting the natural market take care of itself. So I think, unfortunately, we got some, this could go on for a while. Bad markets, the average bear market goes on for about, I thought I had it written down, but I don't. Now, the average bear market goes on for, 2-3 years. It's not like it's just bam, bam, like it was during COVID. I think a lot of people got spoiled because of that. And they got this mindset of like, oh, well, whatever, it's always going to come back. They'll just be like COVID, I'll just hold on. And then after a while, it's like, well, wait a second, maybe it's not going to come back. Yeah. So
yeah, I remember that you put out an article there, like around December 21 or around there. You put out an article about the S&P breaking out in a way that gave you like a sign that maybe it was a little bit toppish. But all those, like, you share articles and things like that with the students as well, right?
Yeah, we cover a lot of things. Every day is a little different. But yeah. Yeah, we saw that the market, this is where we really started to get bearish back here. And I'll tell you why. And this here, kind of the way this indice is designed, it masks underlying weakness, or that's what happens. That's what happened back here, right? And what I mean by that is there's 500 stocks in this index, but two of them together, Microsoft and Apple, are 12%. And if you take a couple of the other big tech names, you got like 5 or 6 stocks that are basically half of this index, whereas the other 495 are the other half. So if those other 495 are going down and money is pouring into the big names that are considered safe, this market here could still be going up, but it masks the underlying weakness, right? Because you think it's the main market's going up because money's flooding into Apple and Microsoft, but other parts of the market had completely broken down. I mean, by January, a lot of the stuff that was the Reddit stuff, was down 95%. Like a lot of that stuff had crashed by September. So the market really started coming apart back here. And one of the ways we can look at that is, instead of looking at this index where it's dominated by just a few stocks, we look at this, which is the Nasdaq 100, but it's equal weighted, right? So every stock has the same amount of influence on the index. So here we see SPY breaks finally at the very beginning of January. But look at this. Look at where we got the signal here from this. So this is where the market really started to fall apart in like mid to late November. So, you know, by the peak of the S&P, this thing was really like on its way down. So, you know, this isn't you know, this bear market is, or this meltdown is not a surprise to anyone who's taken the class and paid attention, Rodrigo.
Yeah, and you mentioned something that was like it was really interesting. You were talking about money managers, because you were a money manager. You've done a lot of things on Wall Street, and you were saying that, you know, like, I mean, energy is really the only green thing out there. So, you know, money, some people, you know, funds might start just chasing performance, and then just, you know, everything oil is just going to be, I don't know, because they're forced to, right? Something, can you explain that a little bit, or for everybody that maybe that didn't listen in the class?
Yeah. Well, everyone thinks that like the hedge funds rule Wall Street, and that's just not true. You know, and a hedge fund is just a type of investment vehicle. It's just like in a mutual fund, you don't pay a performance fee, but in a hedge fund, you do. So in the institutional money managers, where I was the head of trading at, we had various different of these financial products, but the top of the food chain are the big places that need to have money managed for them. And those are your pension plans, or your church endowments, or your university endowments. So, you know, the last place I was at, one of our big hedge funds, the main two clients were a church endowment and a teacher's pension plan. So if you're in a pension plan, you know, you might have money in a hedge fund and you don't even know it. But anyway, a lot of times the people that run these pension plans are not very sophisticated financially. Like we had a client years ago at a firm I was at down in Georgia. It was a Georgia firefighters county, and we went down there and met them, and you know, they seemed like great guys. But you know, the guy was a former firefighter. He knew nothing about financials. All he knew was what he saw on the Wall Street Journal and CNBC. So the way these pension plans work, there's a lot of internal politics and this and that, and sometimes people that really aren't qualified for the job end up in it. You know, because we're talking about like state governments, you know, it's like, you know, state governments, right? But anyway, these people are going to start looking at their returns, and they're going to say, wait a second, my stocks aren't that good. My stock returns are terrible. Oh, all right, well, you know, well, maybe bonds are up, because usually bonds and stocks go in different ways. So then they're going to look at their bonds and they're going to say, wait a second, my bonds are down too. What's working? Then they're going to look at their commodities managers and be like, oh, wow, our commodities guys are doing great. Let's take the money out of our bond managers and our stock managers, all chasing performance. And that, I think, is going to add more to the inflationary pressures. I mean, if there's something that's going to bring oil higher than 140, it's going to be that. It's going to be all this chasing. So I can see that happening now. And was a similar thing back in 2008, where the stock market hadn't performed well. Commodities had done very well, and then commodities just went parabolic. And that's when oil got to the 140 level that we looked at. Rodrigo.
Yeah, I think it's very interesting, Mark, how you're able to provide, you know, like so much education, not just about, you know, the charts and really levels and all the other chapters and much more, but, you know, about really how the inner market works, right? There's a lot of gurus out there, a lot of, you know, TikTok kids and YouTubers out there. And, you know, I guess it's easy for new traders to, you know, to maybe like get distracted, right, with where they should start, right? So I guess it's good that they have this sort of base, this sort of, you know, place in Benzinga that they know that, you know, I have a real instructor. He's been a real money manager, traded, you know, with billionaires like Steve Cohen and Mario Gabelli. I think that's the best type of teacher you would want, like someone that's actually done it.
Yeah, I mean, I've been around the block a few times. There's pretty much nothing I haven't seen when it comes to trading. Because not just when I was at Mario or Steve, like the places I was at after that, I was the head of trading. So I had people under me that I would oversee. And we had all kinds of strategies. We had different products. We had hedge funds, we had mutual funds, we had institutional money management accounts, we had what they call wrap accounts. So I've traded, pretty much every style, everything from high frequency to deep value I've traded. My forte was micro cap and small cap stocks. But yeah, I mean, a lot of these people, when I started looking at a lot of these trading schools to get some ideas, it's like, you got to be kidding me with half of these guys, man. It's like, you got to be kidding. It's like 30-year-old guys who think that, they can rule the world because they've never been in a bad market. And now that things are falling apart, what's going on? Well, we're starting to see cases of other trading schools paying fines for misleading people, which I would never do. So I think you got the whole range of gambits. You got at one end, you got maybe someone who thinks they're doing a good job and is trying really hard, but they just don't have the experience yet because they just haven't been doing it long enough to really get how it works. To the opposite side of the spectrum, where you have people that are just, downright frauds and are willing to lie to pull your money away from you. So yeah, I mean, I would be, I haven't seen anyone who has close to just the amount of experience I have. And, unfortunately it takes time and age to get experience, but I think that makes me just a good fit for the class. And what I like doing too is not just talking about trading, but a lot of people have really misconceptions about how Wall Street really works. Like, what's a dark pool? What's a market maker? What do the market makers do? What's an algorithm? So we spend a lot of time talking about that too, because there's a lot of myths out there about market makers. And I think it's pretty funny where it's like, Rodrigo, it's like, for the 2 years I was a market maker, I never realized that people hated me because I would go to work to rip the little guy off every day. But that's not how it works in the real world. So I like that part of the class too. It's teaching people what really goes on, as opposed to, this mythological, it's the algo's taking it up, or it's in a dark pool. So it's a wide range of education, I would say.
Now, I would say that, I mean, there's about 8 chapters, but I think the most, one of the most crucial ones, right? And you really can't put it, well, you could actually show it on a chart, and it applies on so many different angles, from the retail trader, from the fund side, like you bring all that in. But, within the investment psychology class, I think that's some really good insight, because that's where most traders fail, I think.
Yeah, when people deal with money, their emotions get involved, and that makes you make emotional decision making is not a good thing. People guess, people get freaked out, people get too hopeful, people throw all their eggs in one basket. People blow their retirement savings because they think that they could be an options trader. A lot of people fail because they started out good. Their first couple trades went their way, and now they think that they're the master of the universe, and they put all their eggs in one basket, and they're not humble. Then pride comes before the storm. Pride comes before the fall. And that's another thing. It's kind of ironic, or it's kind of, I don't know if I like this. ExxonMobil paid $40 billion in taxes last year. But some people, and especially the environment we have with the whole Reddit thing, it's like these people think like, I'm a better trader than Steve Cohen is because I bought one stock and it doubled. I mean, so that's emotional. That's when people, these people, like, just out of the blue, like, I mean, like, if you think you could just go in and just go from being whatever you are to just going in and being a trader and being more successful than the greatest traders ever, that's like saying, you can just go walk into the hospital and just go start performing surgery on someone. You need to learn stuff before you do it. But yeah, I mean, I asked people, like, why did you have losses? And it's always, they didn't stick to their rules because they got overly emotional, or they guessed. And sticking to your rules means, or not sticking to your rules means, all right, well, let me look here at SPY. I'm getting close to support here. And I can think if we go down, I think we're maybe starting to get close to where we're going to see a bounce now. But this is our 370 level here, right? So just say, like I just said, I think we're going to get a bounce and we get to 370. And I say, all right, well, if it gets to 370, I'm going to buy it because I think it's going to bounce and I think it's going to get back up to 380. Those are the important levels. But if it gets to 369, I'm going to blow it out and take a small loss because I think it's going to keep dropping. Well, what happens is, it's easy to talk about that, but in real life, when you have that point move down, you start thinking, oh, I don't want to take a loss. Maybe I'll hold on to it until it comes back. And then it goes lower and it's like, oh, I don't want to take a loss. I don't want to take a loss. And it just keeps going and going and going. So people buy things that go against them and they just hold on to them for too long. They hold their losers for too long. Instead of just getting right out of it at 369 with a small loss and moving on to something else, they hold on to it. Conversely, say I'm right and we get to 370 and we start moving higher and we get to 375. A lot of people are just going to start saying, oh, I got a profit here. Let me take it. I don't want to let it slip away. I don't want it to reverse on me. So I'm going to get out here. And it turns out that they sold it too soon. And then it does actually follow through and get up to 380. So emotions and investment psychology are important because you could have the greatest trading model in the world, but if you don't have the right emotional mindset, you're not going to stick to it. And that's what happens. People are successful when they're paper trading, but then when they get real money on the line, they start to make mistakes because their emotions get involved. It's like paper trading and paper trading is easy. It's easy to come up with systems that work, but what's hard is actually sticking to them. So that's really the secret and the importance of psychology there.
Mark, let me ask you a question then. So like, let's say, for example, I'm looking at a stock. I like it. Let's say as an example right now. Okay, I'm looking at an oil stock. I like it and I want to buy it, but then it falls, right? I buy it and it falls. And instead of, going with my 2, 3, 4 month plan of holding it, let's just say I would sell it for a loss. And then, maybe a week or two later, I see it going up higher and I feel like, damn, why did I do that? Do you think does that apply to the investment psychology class from the trader perspective, that sort of stuff?
Yeah, it does, because a lot of times, like if in the situation you talk about, you take a loss, people tend to shut it off their radar screen. They don't look at it. But if you take a loss, if you think something's going to go up and you buy it and it goes down a little bit and you take a loss, maybe you just had it mistimed. So keep an eye on it, and if it starts to go up, then jump in on it, and hopefully that gain will more than offset your loss. So yeah, it's a big psychology thing. It's hard to it's easy to buy stocks, but it's hard to get out of them. When you buy something, it's like, oh, I got a new friend. It's like euphoric. It's but then when you go to sell it, it's like you're taking a loss or a profit, and each of those are going to mess with your head in a different way. I like my analogy that a trading model is like it's like a home gym, or a gym membership, right? It's only good if you use it, not just having it and looking at it isn't, that's not going to do anything for you. You got to stick to it. So that, I think, is the key, is one of the key. Well, that could be the ultimate secret, Rodrigo, is like the ultimate difference between winners and success and failure is emotional mindset and your emotional discipline and ability to stick to your plan. And it's not easy, man. It's not easy. It's not an easy thing to do, but if you follow the fundamentals and the principles, it's not as hard as you would think it is either. The trading school is very, it's built on common sense, experience. We don't talk about like these weird things like Elliott waves, Gann theory. I mean, if people ask me about them, I answer them, but that stuff like just isn't valid. No one in the institutional world is looking at Gann charts or anything like that. So kind of the vision of this class was, as the head trader of a different funds, I would come into work every day, and we would, go and do our morning review and have our meeting and talk about what's going to happen in the market. And that's really what the class kind of is. It's almost like our morning meeting. We're just going through the markets and looking for things to do.
Right. Interesting there, Mark. Can you hear me
Sorry
now?
about that. I just hear my dog is upstairs going nuts. Yeah, so that's what we do. We go through, what's going on. And if you look at the market every day, it gets to, you see stuff.
Yeah, I want to give a quick shout out to Mary. Welcome to the trading school. Let's go. Welcome, Mary.
Hi, Mary.
So,
That's
guys, you
Clifford.
can,
Clifford is a guest in the class. He comes down here sometimes, and I show him, and then everyone posts pictures of their dogs.
yeah, no, well, I mean, look, it's a very fun community. We really can't talk about the school without talking about the students. There's a really fun, awesome, great people to trade. I've seen the progress in many of them from when we started the school, and it's just crazy how, what a change, education and focusing on the building blocks, the difference it makes, right? That's crazy.
Yeah. Well, it's good because a lot of people come into it with preconceived notions, and a lot of people that are new, like, have no notions, and they're amazed to find out how things are so much different than they thought that they really were. Like, how the secret of being successful is so different than what they thought, or how what works on Wall Street is so different, than what they thought. So I think it really clarifies, a lot of things. Like for instance, the things that we were just talking about with the pension plans, chasing performance. No 30-year-old hotshot, man bun wearing young trader guy is going to think about anything like that, because they just haven't been around the block long enough to realize that stuff like that happens. And that could end up potentially being related to a trading idea, right? Well, that's going to add to inflation. So we're going to see inflation maybe go up more than people think about or talk about. So yeah, we cover a lot of different things. And, like I said, I like covering the stuff about how things really work. I think there's this notion that Wall Street is this like little guy versus a big guy thing, and the big guy is out to take advantage of the little guy. And that's just so wrong. This is not how it works in the real world. I mean, like when I just said at the last firm I was at, our biggest hedge fund, we had like 30 accounts, right? And one of them was this big hedge fund. It was probably our biggest account. The two investors in this account were a teacher's pension plan and a church endowment. So when I'm trading for this hedge fund, I am actually trading for the little guy. Maybe the hedge fund is perceived as the big guy, but I'm actually trading for the little guy. So this whole big guy, little guy thing is really kind of just mythology. Look, I'm not saying there aren't shady things that go on Wall Street, because there are, but the vast majority of registered hedge funds that have compliance teams, they're not naked short selling. They're not out there trying to rip people off. It's just not how it works. I mean, I was a market maker for 2 years. And when I got to the school, everyone, it's like, oh, well, the market makers are ripping it higher. The market makers are. It's almost like people don't know what they're talking about. They just repeat what they heard somewhere else. You know what I mean, Rodrigo? It's like, you don't know what's up. Like you're running some trading school somewhere, and you can't figure out what's going on, and you just say, oh, well, the market makers are ripping it. And then everyone's like, oh yeah, okay. But maybe it's the algos too.
Right. So for all the people that just joined here, Mark, what can they expect from a regular day in the trading school?
Well, we spend the first part of the class. Well, I mean, sometimes we get a little out of structure because depending on what's going on, but the first part of the class, we talk about whatever lesson it is that day. So it's levels, trends, momentum. Today was the psychology. Tomorrow we're going to talk about how to do broader macro market stuff. because that stuff doesn't change, right? The principles are never going to change. There's always going to be important price levels. There's always going to be trends. Things are always trending up, down, or sideways. Those trends are always going to have momentum driving them. So that's another class is momentum. We do class on trading models. That's our Thursday class. So we do the first half an hour of the class studying the fundamentals, and then we look into the actual market in real time to see if we can find any trading ideas. Like, for example, class number 2 is levels. I'm watching this 370 level here because I think if SPY gets to it, there's a good chance we get a tradable bounce. And the reason why is because it was support back here. Now, if we break this level, I think our next stop would be down here, 355, because if we go back here, that was resistance and support. So, we could do a thing, and you could go buy a book on technical analysis or watch some recorded YouTube video or something, but everyone's a genius in hindsight. By seeing how this stuff gets applied in the real world in real time, I think it really gives the students an edge over people that aren't, people that are just looking at stuff in the past. Things act differently at different times. When you see a really big, strong move like this here, oops. When you see a big, strong move like this, these big gaps, that was really ripping after a downtrend, that's a bullish sign, typically. When you see something really ripping higher after an uptrend, that could be a bearish sign. That shows you the market's running out of steam. So things act differently at different times. Down here, big moves and gaps are good. Up here, big moves and gaps are bad. Market is acting differently because this is after a downtrend. This is after an uptrend. So, anyone could write a book and say, oh, look at this great idea I had last year. It worked out just like I said it would, blah, blah, blah. But when you look at it in real time, like we're doing, you really learn how things really work. I mean, if people really want to learn how the markets work and really want to learn how to make money trading, I mean, it's, I think it's a good place to be. I mean, this is I have a lot of experience. We've got a lot of students that are really into it. We focus on these fundamentals. We try to take the mythology out of it, keep it simple. And I mean, that's the secret, man. It's like, don't overthink it. It's just like in a lot of things in life. Don't overthink it.
Right. I think that right now, Mark, it's a very interesting time because things are happening right now that, I mean, you could say are pretty, like, I guess, kind of historic. Like, even 40-year, like inflation, 40 something year high, a lot of things that are just very new to people that they've never heard of.
Yeah, it's a confusing time. I mean, it's because, like I said, I mean, this is the first time at least in my career, where people are really even talking about inflation. I mean, when I was a kid, and there was the inflation in the late 70s, but I obviously wasn't working then. So I've been doing this for, gosh, going on 32, 33 years now, and so this is the first time I've ever seen inflation. Well, I shouldn't say that. We started seeing it about 2 years ago, but yeah, I mean, this is stuff that a lot of people who are trading have never seen before. And so we have that. We have this whole bond market meltdown. We have this monetary overspending, forcing all this regulation on the energy companies. Yeah, so these are historic times, and unfortunately, they're not good ones. But we can't, as individual people, we can't really change it. But there's going to be lots of opportunities going forward to make money in the markets. I mean, a lot of people have done very well this year in the class, and considering that the market's down. And how? Well, they've been buying the inverse ETFs when we have big moves lower. Some of them are options traders or put buyers. Some of them are in the commodities and energy stocks. So, there's always a rally somewhere. There's always a bull market somewhere. So these are really, these are bad times to be long-term buy and hold investors, but these are good times to be short-term traders. So that's why I think one of the reasons why we're doing so well
so well, Rodrigo.
Right. So I mean, everybody that's doing the buy and hold is, I mean, look at for example, PayPal, right? If you want to pull up that chart, um, I mean, that's a typical buy and hold stock. I mean, you see it everywhere, like on the news, like, oh, I love PayPal, whatever. But I mean, buying and holding is different, right? Like traders can make more. I mean, that's what we're talking about, right? Like buy and hold versus
Yeah, I mean, if you go buy and hold, you got to wait for years to know if you're going to be right or not. If you're a day trader, at the end of the day if you made money. So it's easier to tweak your system. So yeah, I think that short term or intermediate term could outperform. You hear about these records of guys like Warren Buffett. It was a buy and hold person. But trust me, there are people out there that have performance that's way better than him. You just don't hear of them because they don't want you to. They don't want, maybe they don't want their names out there. But yeah, I mean, if you catch these markets right, you get them on the way up, get them on the way down. I mean, look at this, man. This is back to support from 2 years ago. It's around $72. And it's looking like it might even break and go lower. But it's when the market goes up for 10 years in a row and the only minor blip you have is COVID, which comes back in 2 months. People just have this, it's easy. It's easy to say, oh, you can't outtime the market. Ooh, the hedge funds can't outtime the market. Buy and hold is better. That's just wrong. I mean, I know people that outtime the markets, and they've been doing it for years. So it's just wrong. It's just that the people that don't know how to do it, they're just focusing on the wrong things. So I would say that they're focusing on the wrong things. Yeah, PayPal is good. It's buy and hold is great when it goes from say 87 to 300, but it's not so great when it goes from 300 back down to 72. So think about this, man. Even people that bought it at the very bottom of the COVID crash, if they still own it, they're underwater now. 2 years later here.
Yeah, so that's the thing. I mean, buying and in the trading school, we're pretty much showing students how they can, trade. And look, it could be a swing trade, could be a day trade, could be a 2-month trade, because you break down a lot of information with the students. Like I've seen that you break down reports, you break down analysis of CPIs, inflation numbers. Like you really, dive in there with the numbers. You read it with them, you explain it to them. It just creates a lot of clarity within the trading community there.
Yeah, and that's where we get our ideas. It's like a brainstorming session going through different things. So if an important company reports earnings, we can look at their earnings release. If there's an important economic release, we can go over that. So we cover a whole wide variety of different things. It's a pretty broad thing, but I guess ultimately it's technical analysis. But we get our ideas from a lot of different things. Like looking at the retailer's inventory build up and things along those lines. So it's we have structure, but we do a little bit of improvising too, I would say. Like today, what we were looking at today, we were looking at this. This is interactive brokers. We're just looking at how many accounts they opened, right? Because we can see here they publish their net accounts opening in a month. In a month. So net new accounts, right? So this is back in 2020. So 15,000. Look at that. That's COVID, right? 40,000. That was a spike up there. So these are net new accounts, but 26, 33, so around 30,000. Then we get in here to January. Net new accounts will jump up to 116,000, right? So this is stimulus money. This is the Reddit community. This is January of 21. Then we can see right back in the next month, we're back down to 75,000, go to 60, and then we're right back to like their average around 30. So this is a way to keep an eye on things that are sentiment readings. Like conversely, as we're going forward, if we see these start to get really, really historically low, maybe down to 20,000 a month or 15,000 a month, that'll probably tell us that we're getting close to a bottom because people are losing interest in the market and they're not opening new accounts anymore.
So yeah, there's a lot of different ways to go about it.
Right. No, absolutely, man. And I want to appreciate, definitely thank you here, Mark, for being with us today. I mean, I showed the folks the session and everything, but um, what can you say here for not just for the folks that just began, right? But for the folks here that are looking for a place to get real trading education, why they should give here the trading school a shot, as we get closing remarks here from you, Mark.
Well, because they're going to learn how to make money. I mean, it's pretty simple, right down to the bottom line. It's gonna make money. You're going to learn how to make money. You're going to learn how, at least I hope, you're going to learn how to make money. You're going to learn how Wall Street really works, dispelling a lot of the myth. If you really want to know how the market works and you really want to learn how to profit from trading, you would be remiss to not at least give it a try, with an open mind. So yeah, man, tomorrow there's gonna be a lot to talk about. We got the Fed meeting. We're on the verge of potentially some big moves, big tradable moves here. So yeah, I think it's a great place to be.
Absolutely, man. Well, thanks a lot, Mark. I know you're a busy dude, and appreciate you being here with us. And I'm just gonna show you guys really quick a few things from the school.
All right, everybody. Thanks so much. I'm gonna sign off.
All right, Mark.
All right, Rodrigo. I'll see you later.
Yep, man. Absolutely. And let me just pull up the school here. Okay, I think that's what. Yeah, I think we're good. So this was the live class. It was where Mark was pretty much teaching the whole thing, and if you want to get the recordings of all the classes in the top left, you just click on video library, and it's going to take you to all of the classes, all of the recordings. You can watch them anytime. This one is investment psychology. From what I see, this is the one I was telling you guys about. All you got to do is click play, get it started.
I don't really watch gold anymore because I can't figure it out. I haven't really been able to.
So the conversation goes along a lot of different charts, as you can see, right? You can click now. Also in the chat, I want you guys to know that you have full access there to all to Mark's live trading room, where he's posting entries, trade ideas. It's called Mark's Trade Ideas. You have different chat rooms that the students made on trading formulas, on indicators, things like that they're working together on. And pretty much, if you do want to access Benzinga Pro, which is included with the trading school, you just click on Pro right there on the header. It's all going to be on the header. It'll take you straight to Benzinga Pro for whatever it is that you're looking at, whatever stock you're trading, whatnot. But yeah, folks, that's pretty much a quick review of the school. If you have any questions, reach out. We're going to put the contact there in the chat. So on Twitter, it's in the top left, and in Zoom and YouTube, you're going to find it in the chat. So thanks a lot, guys, for being here. Appreciate it. And we'll see you guys there on the other side.